Escrow sounds like a complicated real estate word, but the idea is simple. A neutral third party holds money or documents until agreed conditions are met. In a property deal, escrow helps buyers and sellers trust the process. The buyer does not hand money directly to the seller before protections are complete. Think of escrow as a temporary safe box. The buyer places funds into it. The seller provides documents or completes required steps. The escrow holder follows instructions from the contract. When the conditions are satisfied, the money and documents are released to the right parties. Escrow matters because real estate transactions involve large sums and delayed steps. A buyer may need inspections, financing approval, title review, and closing documents. A seller wants proof that the buyer is serious. Escrow keeps the transaction organized while both sides complete their responsibilities. Earnest money often goes into escrow. This is the buyer's deposit showing serious intent. If the purchase closes, the deposit usually counts toward the buyer's costs. If the buyer walks away without a valid contract reason, the seller may have a claim to that money. The contract decides the rules. Inspection contingencies show why escrow is useful. A buyer may deposit money but still have the right to inspect the home. If a serious problem appears, such as roof damage or unsafe wiring, the buyer may negotiate, ask for repairs, or cancel within the allowed period. Escrow protects the funds while that review happens. Financing is another condition. A buyer may intend to buy but still need the lender to approve the mortgage. If financing fails under a valid financing contingency, the buyer may recover the deposit. Without that protection, losing loan approval could become extremely expensive. Title review also connects to escrow. The buyer needs to know the seller can legally transfer the property. Liens, ownership disputes, unpaid taxes, or recording errors can delay or block a sale. Escrow does not magically fix title problems, but it helps hold the transaction until title issues are resolved. At closing, escrow coordinates many payments. Money may go to the seller, lender, real estate agents, tax authorities, insurance providers, or service companies. The buyer sees one closing process, but behind it are many transfers. Escrow helps make sure the correct amounts go to the correct places. There is also mortgage escrow after purchase. In many loans, the lender collects part of the property tax and home insurance bill each month. That money sits in an escrow account. When tax or insurance bills are due, the lender pays them from the account. This is different from purchase escrow but uses the same holding idea. Mortgage escrow can help homeowners avoid large surprise bills. Instead of paying property tax once or twice a year, the cost is spread into monthly mortgage payments. The downside is that the monthly payment can rise if taxes or insurance premiums increase. Escrow does not remove the cost, it changes when you pay it. Escrow shortages happen when the account does not have enough money for upcoming bills. Maybe property taxes increased, insurance premiums rose, or the lender estimated too low. The homeowner may have to pay the shortage or spread it over future payments. That is why mortgage payments can increase even with a fixed-rate loan. Escrow overages can happen too. If the lender collected more than needed, the homeowner may receive a refund or credit depending on the rules. This is why lenders review escrow accounts regularly. The account is meant to cover real expenses, not become a random savings account. Buyers sometimes misunderstand escrow fees. The escrow company or closing agent may charge for managing the transaction. This fee is separate from the deposit, down payment, lender costs, and title-related charges. A buyer should look at the closing disclosure carefully to see what is being paid and why. Escrow is not the same as ownership transfer. Money sitting in escrow does not mean the buyer owns the home yet. Signing a contract does not always mean the deal is closed. Ownership changes when closing documents are completed, funds are released, and the deed is recorded according to local rules. The most practical habit is to read escrow instructions. These instructions explain what must happen before money or documents are released. If the instructions do not match what someone verbally promised, the written documents matter. Real estate deals should not rely on casual conversation when large deposits are involved. Sellers should also understand escrow. A seller may accept an offer but still need to wait for contingencies, appraisal, financing, and title steps. Escrow gives structure, but it does not guarantee closing. A strong buyer, clear deadlines, and clean paperwork still matter. Escrow protects trust by slowing the movement of money until conditions are met. It is not just paperwork. It is the mechanism that keeps a buyer from paying too early and a seller from transferring too loosely. In a high-value deal, that pause is valuable. The easiest way to remember escrow is this: the money waits while the deal proves itself. If the inspection, financing, title, and documents line up, escrow releases what belongs to each side. If the deal breaks under the contract rules, escrow helps decide what happens next. Escrow deadlines deserve attention. A contract may give the buyer a certain number of days for inspection, financing, or document review. Missing a deadline can change who has rights to cancel or recover money. The calendar is not decoration, it is part of the protection. Wire fraud is another reason escrow instructions matter. Buyers may receive fake emails that look official and ask them to send closing funds to the wrong account. A careful buyer verifies wiring instructions directly through trusted contact details before sending money. One wrong transfer can be devastating. Escrow can feel slow because it depends on many outside parties. Lenders, title companies, inspectors, insurance providers, municipalities, and agents may all have tasks. A delay in one place can hold the whole file. Slow does not always mean something is wrong, but silence should be followed up. Renters may hear the word escrow in a different context. In some places, disputed rent or security deposit money may be held while a disagreement is resolved. The same principle applies. A neutral holding place prevents one side from controlling the money while the issue is unsettled. The buyer's strongest protection is written clarity. Know what money is being deposited, who holds it, what deadlines apply, what allows cancellation, and what happens if the deal fails. Escrow works best when everyone understands the instructions before emotion enters the transaction. Escrow is not exciting, but it is one of the quiet systems that makes real estate transactions possible. It gives trust a structure. Money does not move only because someone promises. It moves when the agreed steps are complete and the documents support the transfer. For example, a buyer may feel ready to close because the offer was accepted, but escrow still has to wait for inspection, loan approval, title clearance, and final signing. A seller may feel the money is guaranteed, but the deposit may still be protected by contingencies. Escrow is useful because it keeps excitement from outrunning the written conditions of the deal.